Welcome to This Explainer. I'm so pumped to be your professional financial mentor today. If you've ever felt completely overwhelmed by all that alphabet soup in the financial world, well, you're in exactly the right place. Today, we're going to completely demystify the four main types of investment funds. We're talking about decoding how these vehicles actually work behind the scenes so you're empowered to make the absolute smartest, most confident choices for your long-term wealth. No jargon, no confusion, just clear, actionable financial literacy. Okay, let's dive into this. Here's our syllabus for today. 1. The foundation. 2. The passive powerhouse. 3. Active management. 4. High stakes. 5. The agile hybrid. And finally, 6. The mentor's verdict. Section 1. The foundation. What is a fund? Okay, so before we get into the really complex financial vehicles, let's just make sure we're on the same page. Imagine you and your friends are throwing a massive birthday party, right? Now, if one single person had to buy all the food, the drinks, the decorations, the cake, that would be incredibly stressful and super expensive. But if you all just pool your money together, that collective budget can easily cover the ultimate party experience. No single person has to stress over managing every little detail, but everybody still gets a slice of the cake. And you know what? That's exactly how a fund works. A group of investors simply pools their money together, and that massive collective budget is used to buy a huge variety of assets, like stocks or bonds. The fund handles all the heavy lifting of purchasing, and you just get to sit back and share in the overall results without doing it all solo. Section 2. The passive powerhouse, index funds. So how do these actually work? Look, you've probably heard financial influencers say, hey, just throw your money in an index fund and forget about it. But what does that actually mean? Basically, an index fund does not try to guess or pick winning stocks. There's no crystal ball here. Instead, it passively copies a list or an index of companies, kind of like a scoreboard. For example, the S&P 500 tracks 500 of the biggest, most established companies in the US. The Nasdaq tracks those massive tech giants we all know, like Apple, Microsoft, Amazon. The Dow tracks 30 large industrial companies. By just automatically following these scoreboards, an index fund gives you instant diversification, meaning if one single company has a terrible year, it probably isn't going to tank your whole investment because your money is spread out across hundreds of other companies. Now, what's really interesting about this slide is these incredibly low numbers. Because nobody is sitting there actively researching or picking stocks, the fees are absolutely microscopic. We're talking typically ranging from 0.02% to 0.20% annually. To put that into perspective, if you invest $1,000, you might only pay between 20 cents and $2 a year. It's practically nothing. That annual fee? That's what the financial industry calls an expense ratio, and it is absolutely crucial to understand this term. The expense ratio basically covers the fund's management and administrative costs. With an index fund, because it operates entirely passively, you're essentially just paying to use an automated software system, rather than paying the hefty salary of a human manager. Now, there is one little mechanical quirk you should know about traditional index funds. You can't just buy or sell them at any random time of the day and lock in a real-time price. Instead, they operate using something called a net asset value, or NAV. This value is calculated only once a day, right after the market closes, usually around 4 p.m. So say you placed an order at 11 a.m., right? It won't actually go through until the very end of the day at that final closed price. Now, for a long-term investor who's planning to hold onto these assets for decades, this lack of real-time control is totally 100% fine. But it's definitely something to be aware of so you aren't caught off guard when your trade doesn't execute the second you hit the button. And, this simple, low-cost, low-effort approach is historically incredibly successful. Even the biggest experts out there, we're talking about investing legend Warren Buffett himself, recommend index funds for the vast majority of investors. Why? Because the data literally proves it is extremely difficult to consistently outperform the overall market. Just following the scoreboard is almost always a much smarter play than trying to beat it. Section 3. Active management mutual funds. Let's compare these two directly. So while an index fund uses passive management to just kind of follow a system, a mutual fund relies on active management. And what that means is there's an actual professional fund manager, or even an entire team of analysts at huge institutions like Fidelity or JP Morgan, who are actively deciding which stocks or bonds to buy and sell every single day. Their explicit goal is to actually outperform a benchmark like the S&P 500 by picking the exact right investments at the exact perfect time. Which, sounds pretty great in theory. But here is the massive catch. Hiring entire teams of professionals is super expensive. Mutual fund expense ratios often jump way up to anywhere between 0.5% and 1.5%, sometimes even higher than that. And remember what we just learned from Warren Buffett? Studies consistently show that the vast majority of these actively managed funds actually fail to beat the market over the long haul. In fact, over a 15-year period, nearly 90% of actively managed mutual funds completely underperform their benchmarks. So a lot of the time, you're paying significantly higher fees for a strategy that actually performs worse than a simple passive index fund. Crazy, right? Section 4. High-stakes hedge funds. Now, if you thought mutual funds were aggressive, hedge funds are just a completely different beast. These are highly exclusive private investment funds open only to wealthy, accredited investors or massive institutions. And the reason for that, the strategies they use are unbelievably aggressive. They don't just buy and hold stocks. Oh no, they use intense tactics like short selling, derivatives, and leverage. And leverage literally just means they are borrowing money to invest even more money. They're chasing these massive market-crushing returns, but taking on that level of risk means they are subjected to wild volatility. Sure, they can generate absolutely huge profits, but they can just as easily suffer devastating total losses. And this brilliantly illustrates why hedge funds are strictly for high net worth individuals, the famous 2 and 20 fee model. Get this. Not only do they charge a flat 2% annual management fee just for the privilege of holding your money, but they also take a massive 20% cut of any profits they actually make for you. It's an astronomically high barrier to entry, which heavily contrasts with those tiny pennies you'd pay for a standard index fund. Section 5. The Agile Hybrid, ETFs. Let's step away from the billionaires for a second and bring the focus back to you, the everyday wealth builder. ETF stands for Exchange Traded Fund, and you can really think of it as the modern upgrade to the classic index fund. ETFs possess some really cool superpowers. Just like an index fund, they are generally passively managed, they track a broad market scoreboard, and they offer that same instant diversification with incredibly low expense ratios, usually sitting right between 0.03% and 0.75%. But here is the absolute magic trick. They trade on the stock exchange exactly like a single individual stock. Plus, so many brokerage platforms nowadays let you buy them with zero commission fees, making them unbelievably accessible for pretty much anyone. Let's move to and see how this builds perfectly on what we learned earlier. Really, the only major mechanical difference between an index fund and an ETF is just how they're traded. Remember how we talked about index funds being priced just once a day at their net asset value, right after the market closes? Well, ETFs can be bought and sold in real time throughout the entire trading day. You can literally sit there, watch the price move minute by minute, and execute a trade exactly when you want to. It beautifully blends the steady, safe diversification of a fund with the agile, fast-paced flexibility of a single stock. Section 6. The Mentor's Verdict. We've covered a ton of ground today, navigating all the way from everyday vehicles up to Wall Street's most exclusive clubs. So let's play matchmaker and pull this all together. If you're a high net worth individual who totally understands complex, aggressive risks and you don't mind paying exorbitant fees for a chance at massive returns, well, hedge funds exist for that very specific tier. If you have a deep, strong belief in a specific fund manager, or maybe you want highly targeted exposure to a super specific niche sector, actively managed mutual funds might serve a purpose in your portfolio. But as your mentor, here is my core verdict for the vast majority of everyday long-term investors who just want to build real wealth. Index funds and ETFs are the absolute sweet spot. They're low cost, incredibly easy to understand, and they offer that broad diversification you need to build a rock-solid financial foundation, all without constantly stressing over the market. So the power is entirely in your hands now. You know how these tools work behind the scenes, and you know exactly what you're paying for. The only thing left to do is to take action. So I'll leave you with this. Which low-cost, low-effort vehicle will you choose to start building your financial future today? Think about that, and I'll catch you in the next explainer.